Hello, this is Ahura, and I'm here with you to review the central banks meeting in United Kingdom and Europe, and also to see the US inflation data and check what's what we can expect with these data and how markets reacting to these numbers. Starting with the British Central Bank, BoE, Bank of England, cut the rates by 25 basis point as it was widely expected. We didn't have a surprise in the decision or the voting numbers. That was what happened. What happened was what was expected. But with one more, just with one vote more, the central bank cut the rate. That's why somehow the market reacted that as less, not too much dovish. Somehow just like cautiously looked at these numbers as the central bank increased the economic growth expectations as well. We will talk about that later. In the Europe, in the Eurozone, European Central Bank also did what was expected. They hold the rates at 2%, which was it was widely expected in the markets. However, in the European Central Bank also, they increased the economic growth expectations. So that's why we can say that somehow it was slightly hawkish because some members, they are already talking about the possible rate hike in 2026. We will talk about that also, about the monetary policy decisions. But looking later in the United States, we had the inflation numbers and also the jobless claims. Inflation was surprise of the day as the United States core inflation fell to 2.6%, while market was expecting to see the inflation remained unchanged at 3%. The core inflation at 2.6% and the headline inflation is to 2.7%, while the market was expecting to see the inflation grow to 3.1%. That was the surprise of the day. On the other hand, while we can see that okay, inflation is slowing down, so we can expect the Central Bank of United States or Bank of or Federal Reserve to cut the rates in January. On the other hand, we can see the labor market is fine with only 224,000 new applies for to receive the unemployment benefits, while the continuing jobless claims slower to 1,897,000. What does mean? It means that the U.S. labor market is strong enough and doesn't need help. So while the inflation gives the light green to the central bank to cut the rates, on the other hand, the labor market says that I don't need your support. This is while the Federal Reserve also increased their economic expectations. So again, there are some balance between the lower inflation and a stronger labor market, and we cannot say that okay, this data can increase rapidly or can increase more clearly the expectation of the rate cut expectations. We should wait for next week's PC price index and core PC price index and personal income and spending numbers, and also the January's NFP and inflation number. But for now, we can say both sides they can still it can hold the balance between the supporting between the group that's supporting the rates cut and the group that they're supporting the rates holding the current rate for a little bit longer and cut the rate in a second quarter. Looking at the central bank decision, what we saw today in the European Central Bank and the British Central Bank, in some part, they look like what we saw in the Federal Reserve. All these three main central banks, they increased their economic growth expectations. This is what the central bank in the United States did. This is what the central bank in the Eurozone did. And this is what the central bank in the United Kingdom did. They all increased their economic growth expectations, while all of them, we can say somehow they lowered their in a bigger picture, they lowered down their inflation expectations. In a bigger picture, it means that not comparing the previous meeting, not to the previous meeting, compared to 3 or 4 meetings ago, when the tariffs and the trade war started, all these central banks, they lowered down their economic growth expectation and they increased rapidly their inflation expectations. Later, we saw that this uh, trade war didn't affect the market as they were expecting. I mean, it didn't affect the inflation as they were expecting and didn't affect the economic growth as they were expecting. So they again increased their economic growth expectation to the same level almost that they had at the beginning of the year before trade war started, something like 1.7% for the US GDP growth. It was what the Federal Reserve was expecting at the end of 2020 for the 2025. So that's why we can say that these numbers, they didn't change something specially in the market for I mean, this trade war actually didn't change something special in the economic growth and inflation growth expectations. While at the same time, the inflation, they increased the inflation and then they slowed it down. So comparing maybe that, for example, in Eurozone, maybe the inflation expectation is slower down, is increased for the next month. But if you look at the comparative with the meetings for the European Central Bank increased the inflation expectation for 2026 to 1.6%, 1.9%. This is what it was slightly lower, but the thing is that it's still lower than their expectations that they had around 2.2% at the beginning of the year, at the beginning of the trade war. So what we can see right now that generally all this, if you look at the bigger picture, if you look at this not just in a small window, if you look at the bigger picture in a bigger window, we can say that all these central banks, they lowered down their inflation expectation and they increased their economic growth expectations. That's why, for example, in Europe now they see that okay, the interest rate at 2% is too low, and they are talking about increasing the interest rates in 2026. There are some voice actually talking about that. That's why we can see today's decision in Europe, it was somehow hawkish. That's why in the British Central Bank or in the Bank of England also, while they cut the rates by 25 basis points to 3.75%, at the same time, there are some voice that you're talking about, okay, maybe we should hold at this level as the economic growth is getting slightly better and the inflation is getting lower, so we have to wait a little bit more. That's you saw the inflation data for United Kingdom yesterday. Inflation has fell to 3.2% rapidly from previous 3.6%, while the market was expecting only around 3.4%. The same, so the trend is the same as the economy is moving forward, but at the same time, if you look at the UK economy and if you look at the European economy, it's a different story with the United States economic growth. As in both these economies, we have really the domestic demand concern. They have to solve, but they have to solve this issue. And for solving this issue, European Central Bank, it's very hardly to accept that they want that they are going towards the increase the rates. This is what happened in the central banks in U.S. economic data. Let's check the charts and see with these economic data that we had what we can expect, what we can see in the charts, and then what we can expect. So as the central bank's decision is already known and the inflation data is the same, it's slowing somehow the inflation. We can say that okay now. But the market risk can slightly ease, and from previous 18.88, now we can see the market risk lower at around the VIX under 18. Probably we can see later today and tomorrow. This slowing risk in the market, but we can. I mean, I don't expect to see the VIX at 17. Still, the VIX around this area, but slightly lower. With this slowing inflation, with this slowing market risk, and with this slowing inflation, we can say, okay, now the expectations for rate cut in January meeting can slightly increase, and that can put the pressure on the US dollar index. However, as you saw, that the labor market was strong, so. So still this balance cannot, as mentioned earlier, still this balance cannot put too much pressure on the dollar index. That's why we can expect the dollar index not to increase to 20 towards 99. We can expect around 98. 98 a little bit higher, 98 a little bit lower, but around the 98. This is the more acceptable level for the dollar index, at least for a short term. Started with the dollar. Let's finish with the U.S. stock market, and then we can go to the eurozone. As the reaction for the cryptocurrency, as the reaction for the stock markets, there, these decisions, yes, they can increase the expectation for the rate cut slightly, but as mentioned, with this balance, so the reaction in the stock market can be sideways. That can, we can say somehow that maybe it can slow down the downtrend that we had, but it cannot change this downtrend to uptrend. So with these expectations, with this data, we can, our expectations will change for the Europe, for US stock market can change to the still the, I mean, side movement, not to the downward. I mean, the downward tendency, we were expecting the side movement with the downward tendency before, slight downward tendency. Now we can say side movement with the slower downward tendency. So around this area, but we cannot expect with this data, we cannot say that, okay, that the market can accept a higher risk. We cannot have to say that, okay, now we have a higher risk in the market and stock market can fall further. Very, I mean, the downward will be very, very slower. Same for Nasdaq, same for the Dow Jones 30. For the cryptocurrency, also same. We can say with this data, we can expect the Bitcoin to make some ground for itself, to create some ground for itself above $84,000. And if the BTC can hold the $84,000 and not break under this $84,000, can slightly create a foundation for itself to slightly increase from here, especially if it can increase above $92,000. But still, above $84,000, we can say that can trying to be sideways around this and can create some foundation for itself. But still, we don't have a clear signal for the upward, I mean, for the bullish trend. But for the downward, for the bearish trends, for bears, we can say that now we have a less expectations. As for the European Central Bank decision, European Central Bank, as mentioned, the decision was somehow hawkish because of the expectations. That's why we can expect the euro to slightly gain against its crosses. So the euro USD should probably be around, moves higher towards 1.18. That's what we can expect for the euro US dollar, while the European stock market, which was falling in the recent days, with this decision can somehow gain. However, this gain also can be affected by U.S. stock market, but that can be short-lived. So for the European stock market, also we can expect side movement, not the higher. This decision cannot support them to increase much higher, but the downward also we can say that the downward also can be controlled. As for the stock market in the United Kingdom, but for GBP, let's start with the pound. British pound, this decision, since the BoE or Bank of England cut the rates, this decision cannot be positive for the British pound. It can put the pressure on the British pound. The initial reaction mostly is because of as you can see in the GBP/USD chart, this initial reaction is mostly because of the weaker dollar at the first reaction, but we cannot expect this trend to go further. For GBP/USD, it can be it can be negative reactions, and most probably we will see the side movement with the downward tendency for GBP/USD further this year. Later, looking at the stock market, this decision somehow can support the stock market as they cut the rates, but as I mean, very cautiously, we can say that the stock market can be supported very cautiously. Side movement with a very slight uptrend tendency. That's what we can expect from this decision, because the votes, they are so close to each other. Inflation is slowing down. The economic growth, they increase their economic growth expectations. So rapidly going towards the rate cut is not something that with these data we cannot expect that, okay, Bank of England to go towards the rate cut rapidly so fast. And that's why, okay, we can say, okay, this decision can be somehow side movement. I mean, this somehow the side movement and slight bullish tendency for British stock market. That was what's happening in the market and the reaction. Talking about the reaction, but if you want to say this reaction for the gold, I have to mention this reaction for the gold can be positive generally, even thought just like because if the interest rate expectations increase, again, the safe havens will increase the gold demand if the inflation expectations, if the expectation for cutting the rates increase, the weaker dollar will support the gold. If the holding the current rate increase, the money moving out of the stock market again, looking after safe haven, and that can increase again the demand for the gold. So for gold, we are still positive, and in a bigger picture, don't look at the first candles. In a bigger picture, still we are expecting to bullish this bull. I mean, the uptrend to continue in a bigger picture. That was what's happening in the decision in the central banks meetings and inflation data and markets expectations. Have a good time. Talk to you soon. Bye-bye.